All right, good afternoon, everyone. My name is Marissa, and I will be your administrator today. Welcome to the June 2023 First Friday webinar. Today's presentation is titled, Will Artificial Intelligence Save the World? Our prepared comments during this session will be recorded, as other families who are unable to attend have asked us for the recording. Please note we will not record your questions, as privacy is always a top priority for our firm. Our prepared remarks today will be between 15 and 20 minutes long, with some time left over to cover questions from the participants, along with our standard topic, which is, what is the market missing? If you have already sent us your questions, we want to thank you because your questions help us understand what topics are truly important to each family that we serve. If new questions arise from the content of today's presentation, please either send the question along by typing your question in the chat box at the bottom of the screen, or write it down and raise your hand at the end by clicking the icon at the bottom of the screen. We will do our best to come to you at the end with prepared comments. One final note, please remember to mute your microphone and stay on mute, as background noise is audible and distracting. With that said, let me turn the presentation over to Stephen Abernathy, who will provide today's commentary.
Great. Welcome everyone to June's First Friday discussion, and as always, you know, I thank each of you for setting aside the time to discuss some of what I think the world or the financial world thinks are increasingly important topics. Today, we're going to follow a similar format to last month's First Friday meeting, in that we're going to talk about sort of the most important questions we can find today that are, excuse me just a second. The most important questions today that we think are, in some cases, pivotal moving forward with the capital markets. During the last meeting, we said that we couldn't recall a period in which there's been such a significant disconnect between the data and the market's reaction to the data. And we commented further that it was almost as if the global capital markets are trying to ignore the data. And it's still the case today. It's sort of a real head scratcher as to what is really going on. And while it could be the amount of stimulus in consumers' pockets, that's not showing up in credit card data. It's not showing up in the results from companies like Dollar General and Macy's and sort of the lower end retailers. So I guess what I'd like to say is the signals or the leading economic indicators, as we've gone over several times in these discussions, they're telling us that difficult times are likely, and over the next year, while the stock market remains singularly focused on the noise and the hype of what I would call disinformation, or sort of whistling past the graveyard. So I want to take just a brief moment and remind each of you that the index of leading economic indicators and the yield curve both are signaling that they're, you know, as I mentioned before, they are the two most accurate indicators of the future economic indicator, and both indicators have preceded every single recession since 1945, and both are signaling a recession is in our future. So there's two important reasons that avoiding recession may be more important today than at any other time over the last 75 years. And we sum it up in one word, which is leverage or debt. The extreme leverage created by over the last 12 to 15 years of lower than natural interest rates truly has become dangerous. And it means our debt problem will remain a consistent and ever-present source of discontent. And I'm not trying to be a glass half empty person. I'm just telling you that some of the math, just the third grade math that you apply to our debt levels, becomes almost, we will never be able to repay it. So inflation must be part of our future, and maybe in a significant way. So I guess the bottom line is our debt problem is likely to be the source of many problems to come in the future, and we're afraid that it will all come home to roost at once, which is disastrous. So the two events which are most important today, and will remain important today, are number one, the earnings. As we discussed in the last two meetings, the earnings decline an average of 20% during recessions. During severe recessions, it's more significant than 20%. When you apply a 20% discount to the current earnings estimates in today's overvalued market, relative to history, this means that there's the likelihood, and it is very real, that there's a 30 to 50% downside in equity prices on their way to fair value. The other reason avoiding recession is important this time is that debt often creates leverage, both up and down. The amount of debt at the government level and at the corporate level. And this month, we created a new level of consumer debt, a record level of consumer debt. They're all at historical records. And while this may have been important and helpful in compounding gains of the last 15 years, it's as likely as not to become a chain around our neck or the US economy's neck during the next decade. So in today's First Friday webinar, let's discuss the most instructive questions we've heard since our last meeting. First, will the US political discord during the debt ceiling create problems for the US economy and or the investment community? Forget the fact that it was incredibly embarrassing. We are, we are the world's currency. And it's just terrible. Stay with me just a second here. Number two, will inflation and employment, which is higher than the US Federal Reserve wants, will it cause a problem, and will it cause the Fed to increase interest rates farther than they need to? And can we really avoid a US recession? And number three, everyone hears about artificial intelligence everywhere today. It reminds me of the dot-com bubble. This narrative says that artificial intelligence, or AI, will change the world in a manner similar to the Industrial Revolution, electricity, the computer, and the internet. Who are the winners and losers? And we're going to discuss each of these. And if it's possible, I want to remind you the questions and answers may very well create attendant questions. And because this is a town hall comment format, please feel free to put your questions in the bottom of the screen in the chat box, and Marissa will read them at the end. And I promise you, we'll get to all of them. So, was the embarrassing debt ceiling spectacle, is it going to create uncomfortable challenges for our US economy? And the first slide is the slide that we offered last time to start this off. During the last embarrassing moment for the United States regarding the debt ceiling, the market was down 20% on the charades that our political appointees took us through. The differences today and then are significant, and they're key. In 2011, we resolved the debt crisis, but we had less than $900 billion in debt, which I know that sounds like a lot of money. At least it sounds like a lot of money to me. However, in today's magnitude, it's nothing. Today, we have over 9 trillion at the Federal Reserve's level. And at the national level, we have 32 trillion in debt. This is incredibly dangerous for the world's currency. Don't forget, we're the world's currency now. In 2011, our Federal Reserve was increasing liquidity. And in 2023, our Federal Reserve is decreasing liquidity in an attempt to slow the economy. Let me take a look at both of these time periods outlined in the red circles. This is incredibly, incredibly dangerous. As you can see, the difference between we're going to discuss in just a second, the difference between a hard landing and a soft landing, which is incredibly important over the course of the next year or so, is that an economic recession is most often defined by whether we enter a recession with the Fed increasing liquidity or decreasing liquidity. So increasing liquidity produces a softer landing, and obviously decreasing liquidity, as they are now, produces a hard landing. One more comment. Last month, we discussed the fact that we thought Congress would come to an agreement at some level. Didn't know when, didn't know how fast. What we thought was the funding of the Treasury's general account, the TGA, would create a problem. We still have that in front of us. Please be aware to look out for the fact that over the course of the next month or so, we have to sell over $1 trillion in US bonds to replace the equivalent of the United States Treasury's checking account. Does this create ripples? I would tell you that it has every probability of doing so. This is 5 times the level of debt that we're typically trying to raise over a monthly period. And hopefully we can do it over a longer time period so it doesn't crunch. But I will tell you, if but most of the families that we serve are increasing the duration of their bonds, this is the time to do it, because the United States Treasury is going to be pushing bonds out for sale. That will lower the price of the bonds, and it is likely to increase the yields available. Just keep that in mind. Inflation remains higher and employment remains higher than expected. What happens next? As we said last time, or you're probably getting tired of seeing this slide, but our stance, for the last 6 months has been that inflation is going to be a lot stickier than the Fed believes it's going to be. The Fed has us returning to the below 3% inflation, even closer to 2.5% inflation by the end of this year. That is, I think, that's crazy. I don't think it's going to happen. And the data it doesn't matter what I think. Let me just be humble enough to tell you that I'm not an economist. I'm just saying that historically, this has never happened. It's never happened in less than 6 years. So the bottom line, you can read the slide, is once inflation passes 9%, the rate of inflation has never been brought down to below 3% in less than 6 years. Here's where we are now. The blue line is inflation without housing data. The orange line is consumer price data. The problem is that the blue line looks great, and it looks like we're on our way back down to that 2% rate. The problem is housing inflation makes up over 30%, much closer to 35% of the CPI, of the Consumer Price Inflation Index. So ignoring it is ignoring a fundamental cost for every citizen. Here's a slide from the Atlanta Fed, and I want you to concentrate on line 1, which is the actual stated inflation rate. Line 4, which is the core inflation rate, and the CPI core inflation rate, which is the bottom row. Each of these numbers easily sort of attest to the fact that we believe the data support inflation coming down. And we believe it's going to come down much more slowly than the market expects, but it's coming down, and that's a good news. With a Federal Reserve that is impatient as they are, we believe this is a problem, because what they really need to do is to understand that their rate increases have an effect with long and variable lags. And it's just, we need to give the tightening time to affect our economy. Don't forget, we just started rates increasing in March of 2022. And in March of 22, March, April, May of 2022, we were at 2% inflation. 2% from 0% is a big move in percentage terms, but in absolute terms, it's really almost nothing. So the real effects of the inflation increases, or the real effects of the rate increases, have had little effect so far. And we're already starting to see cracks. The banking system is front and center. Here's the problem. This chart shows bank loans, and it also has gray parts with recessions. And as you'll see, the correlation between bank loans and recessions is almost perfect. The problem is the banks ceasing lending or lessening lending. This chart says that they've almost ceased, and in some places they've started to call loans. This is effectively another level of the Fed tightening, and this is equivalent to at least 0.5 percentage point in rates being higher, even if you can get a loan. It's just another form of the Fed tightening, as I see, and economic conditions are getting worse. So since 1960, we've had 12 recessions. 8 of them have been a hard landing, and 4 of them have been soft landings. What separated the soft landings from the hard landings. As we said earlier, it's the Fed increasing or the Fed tightening moving into the recession. And this is hard evidence, this is just data from our history that shows as the Fed is increasing interest rates into a recession, we move into a hard landing. And as they're being more forgiving and offering, what it really says is that the Fed is behind the curve. They're still trying to tighten and kill inflation when we're actually in recession. And this is the fear. So this problem is sort of, how would I say it? It is reinforced or increased by the fact that our debt load today is 125% of our GDP. And in each of the past recessions, our national debt was at less than 25% of GDP. This is a huge difference. This is, when you look at our debt load now, it's 500% of what it used to be. So getting a recession or getting a recession light or getting a soft landing correct is really, really, really important. So it's something that each of you should have a wary eye on, and just be aware that the risks this time are significantly higher than they have been in the past. Artificial intelligence. What are the most likely effects of artificial intelligence, and who are going to be the winners and the losers? So we think this is going to be similar to the dot-com bubble in 1999 and 2000. And it's funny because it was the beginning of a recession in itself. The parallels are almost frightening. You have companies, the breadth of the United States capital markets has narrowed to the point that the top 10 companies are responsible for 118% of this S&P 500's gains for the year. Meaning, if you had an equal weighted S&P 500, we would be down about 3% for the year. So while the benefits of AI are real, just like the benefits of the dot-com bubble were real, it's going to take time to realize these benefits. Currently, the first order or the first companies to benefit will be the hardware companies. They will be the beneficiaries that build the infrastructure that's needed to implement, we believe, the AI. Then we'll have to learn how to integrate AI into our corporate and our government operations, with an emphasis on our government operations first. Good Lord. Sorry, don't want to be political here, but our government could use all the helping hands we'll get. At a point that the rest of the economy starts to benefit from the increase in productivity that artificial intelligence or AI will bring, it means we're going to be able to do more with fewer people. And this will be a challenge into itself, because it's not going to affect the lower and the lower end of the middle income families the most, like inflation has been. This next efficiency or productivity improvement in our US economy is likely to implement or hurt the white collar sector much more than the lower collar, than the lower earning or some of the lower middle portions of the earners. So middle management of America, the white collar sector, is going to be less needed, and there's going to be less human interaction needed as AI becomes implemented and integrated into our everyday functions. Let me just stop there, because we're getting long, and I want to be respectful of everyone's time. Marissa, are there questions from the attendees? Are there any questions that might be there?
Yes, we've got a couple questions here. Our first one says, you keep discussing indicators which are supposed to be leading indicators, and you keep telling us they're indicating that our US economy is weakening and going into a recession, and that a recession will mean earnings will decline by 20% or more based on historical examples, yet the market continues to remain at or near all-time highs. So what is wrong with your analysis?
Wow, gosh, guys, this is supposed to be friendly. It's a good question, and it's the right question. And I think what we're all guilty of, me included, is the time lag. Can you remember when you were a kid and you got in the back seat and you constantly asked your parents, "Are we there yet? Are we there yet?" I think that's a fair. I think that's a fair comparison. Maybe not, but we've been watching the inverted yield curve now for over 12 months. We've been watching the leading economic indicators tell us that we're heading for a recession in over 12 months. What we're guilty of is not understanding the fact that both of these indicators lag by 12 to 18 months. The Fed's tightening cycles, it's very clear. There's a 12 to 18-month lag. I'm really surprised that the Fed hasn't pushed more on the fact that they need to be patient. During the June Fed meeting, they're likely to hike again. They shouldn't be. They should just be pausing or skipping a hiking cycle to see the effects of their hikes so far. So I guess in short, I am more convinced than I was last month. And last month, I was more convinced than I was the month before that. We are heading for a recession. I think it's impossible to tell you when. I think it's equally impossible to tell you how hard it's going to be. But I will tell you that the probabilities exist that the recessions to come, while we're indebted at levels that we're indebted, are likely to be worse than they could very well be worse than historical recessions. Maybe that if that doesn't answer the question, please come back to me with more. Marissa, anything else?
Yes, just a comment following that. It says the few analysts who predicted the housing crash in 2008 were eventually right, but they looked completely wrong until they looked omniscient, right? Could this record stock market be the same type of event? Predictable, but just hard to say exactly when.
Yes, it really is a matter of time. You know, one thing has to bump into another, and there typically is a cascade of domino effects. And as you remember, don't forget, the banks started to fail in 2007 with Lehman in 2007, and it was 9 months before, I'm sorry, that was Bear in 2007, and it was 9 months before Lehman almost brought the world to its knees. And again, in the last market outlook, I wrote that it was one of the most frightening points in my financial history. I was at a meeting with Hank Paulson in New York and he was literally almost speechless. He really didn't have answers. He was hoarse. He could hardly speak. We were on the verge of a global financial collapse. It's not that bad this time, I don't think. The last month, we had a question on commercial real estate, and I haven't been able to aggregate enough data on the commercial real estate market to make a few slides on it. But I will tell you that the commercial real estate market is bifurcated, or it's not bifurcated. It's sort of segmented into at least 11 different sectors, with the real problem, which is office space, representing about 3% of America's real estate. So it is likely to be a problem, but it's not likely to be the kind of problem that our housing problem was back in 2007 to 2009. To summarize, I thanks for the question. It's a really good question. It's a really good comment, by the way, and it's foresightful. I think that we're missing the lag here. We just need to have more time before we see what the rate increases and the lack of liquidity. Don't forget, we were still infusing liquidity into 2022, into the marketplace, despite the fact that we were clearly slowing our economy. So I hope that helps. Marissa, anything else?
Yes, I have another question for you. Why
Yes.
is there so much focus on inflation over the last year plus? We know inflation comes and goes, and over the last 15 years, we've been trying to increase inflation, and we could never get the inflation rate over 2%. So why is everyone worried about inflation, and why is there so much emphasis on getting inflation back to 2%?
I'm the word arbitrary is one of the topics of the current market outlook that I'm working on for all of you. And there's data upon data upon data that show that inflation rates somewhere into 3 to 4% are much better for our U.S. economy. Our U.S. economy operates at a more effective and a more efficient in a more effective and more efficient way, and the productivity per dollar in and per dollar out is way more effective. I don't know where this 2% inflation objective came from. I think that it came from Bernanke back in the 2007, 2009 downturn. And I have a feeling it was an arbitrary number at the time, because there is no data. There are no data and no, how would I say this, research that support a 2% inflation rate. At the end of this chart, this PowerPoint presentation, I have some charts that will show you what the damage that inflation does. It is the silent thief. It steals from all of us, and it is the only way that we'll be able to pay back our U.S. debt. So I don't know. I mean, I do know why the world is so worried about inflation. It is a terrible event. However, we're going to have to let inflation run hotter than 2%. Mark my words, you'll see. Marissa.
Okay. Yes, one last thing. I believe we touched on this last month a bit, but last question coming in says, what will the US Federal Reserve do if something in the economy breaks or a catastrophe occurs before inflation is conquered?
Our opinion is, and this is just our personal opinion, our opinion is that they will pivot. We have circumstances and we have cases that we just had a bank failure or several banks fail. And this was in the middle of our tightening cycle. And what did the Fed do? The Fed infused the same amount of money that they have been able to take out of the economy over the prior 9 months. And they did that in 1 week. So the minute our economy is challenged, I reckon this to sort of, your child falling down and skinning his knee. And we as parents, we run to go help our child. The minute that we get into trouble, we believe the Fed will pivot. And that is one of the reasons we've been advocates of lengthening the duration of our bond portfolios, because as the Fed pivots, we think that they're going to pivot back down to the point of being neutral, which is probably around that 3.5% level from a 5 or 5.5% level currently. And that's going to be really a solid backdrop for longer bonds. Let's see. I think that's it. We have three real quick charts that are incredibly interesting. Let me just do these for you real quickly. So what is the market missing? And it's all about inflation. What have the impacts of inflation been over the last 30 years? How has it impacted our economy? And what's inflation's impact over the longer term? And I want to ask you a real quick question just to think about before I put this data up. In 1920, we had $1. If you took that dollar and you went shopping with it today, how much in goods would that dollar be worth? So in short, what do you think a dollar's value is today versus 1920s? And I'll show you a quick chart that gives you the answer. So today, I think this is an incredibly interesting slide. It shows the impact of inflation when you take away the amount of money our government has infused to our economy over the last 30 plus years. So in short, we haven't grown a lick in the last 30 plus years relative to the amount of money which is into our government is infused into the system. And to tell you the truth, you can see that we've actually shrunk a bit. Number two, maybe this is more important. What's our net worth like relative to inflation? This chart clearly shows that our household's net worth over a similar time period, that's about 30 years, we're probably no better off today than we were in the late 1980s from an inflation perspective. In the last slide, which is the answer to my question to you, please take a guess. What's a dollar worth today in 1920s currency? And if you said 4 cents, you were right. 96% of the value of our dollar has been inflated away over the course of the last 100-ish years. So don't ignore the impacts of inflation, please. And this is a topic that we'll address as we speak with each of you over the coming month or so. So the last piece of information I want to do real quickly is I've been referring, this is a developing story for you. I've been referring to the debt overhang nationally and in corporate America, and now at record levels at the consumer level, as a worrisome piece of data. Small business defaults have already started to increase at alarming rates. I'm just getting this data in now. We can discuss this in the future, yet I will leave you with one slide that's a little bit dated that will hopefully remind each of you to act with safety first. We're starting to see defaults at the smallest corporate level, which is the first shoe to drop. This typically leads to larger corporations, and who knows where it stops. But with the amounts of debt and leverage in the system, it's worrisome. It's worrisome squared. I think we've been a little bit over this month. We were over last month too, and I'm sorry. I wanted to ensure we covered the topics that were on our radar screen. And if there are other questions or comments, or if the topics we talked about today generated some additional questions, please feel free to come back to me, please. And with that said, let me know whether you would like to continue these First Friday meetings during the summer months, because I know a lot of people are traveling, and I want to be sensitive to your travel plans. So if I'll reach out to each of you after this call to find out whether you'd like to continue having these First Friday meetings. I would like to. but it's up to you. With that said, onward and upward, guys. Thanks for attending.
All right, this will end our June 1st Friday webinar. We hope you enjoyed the content, and please, again, send us any ideas you would like to include in July's first Friday webinar. Thank you, everyone. Have a great rest of your day and a great weekend.